On Wednesday, the FTSE 100 climbed 2.2% in a single session, its strongest daily gain in weeks. Oil dropped below $100 a barrel for the first time in over a month. Axios reported that the United States was close to a ceasefire deal with Iran, and traders bought the news hard. The pound strengthened. Miners surged. Bank stocks rallied. By the close, the mood on the floor felt close to relief. 13,000 flights were being cut from the May schedule at the same time. The airlines were not celebrating. British Airways owner IAG had already warned it would raise airfares as fuel costs soared. Ryanair's boss was calling for tighter airport controls. Trainline, which reported full-year results Wednesday, saw its share price fall 3.7%, despite a solid earnings beat. The market took note that Middle East tensions were hitting European rail bookings too, according to the company's own guidance. The dual signal was hard to reconcile: equities pricing in a ceasefire, the travel sector pricing in a summer that may not fully arrive. Goldman Sachs had provided the mechanism a day earlier. The conflict, Goldman noted, had done more damage to refined petroleum products, jet fuel and diesel, than to crude oil itself. The Arabian Gulf's capacity to export processed fuels was compromised in ways that a peace deal alone could not immediately repair. The Iran war hit the downstream end of the energy chain harder than the upstream, and the downstream end is exactly where airlines live.
This is the part most investors missed in Wednesday's rally. Crude oil and jet fuel are related but not identical. Refinery capacity in the Gulf, which processes crude into aviation fuel, was disrupted during the conflict. Even if a ceasefire is signed, the refinery infrastructure does not come back online at the same pace as diplomatic headlines. Goldman Sachs estimated the jet fuel supply shock would outlast the crude shock by a meaningful margin. The airlines had already built that gap into their May schedules. The 13,000 flight cancellations were not a reaction to Wednesday's news. They were based on a supply picture compiled weeks ago. IAG, along with other carriers, had signaled fuel surcharges were coming to offset a cost base that had moved structurally higher. The Guardian reported that airlines were among the first companies in the UK to formally apply fuel surcharges, pricing the disruption into tickets before the geopolitical headlines began to soften. Here is where the logic gets complicated. A genuine, durable ceasefire would eventually ease refinery pressure. Jet fuel futures would drop. The airline cost base would normalize. The 13,000 flights already cut would not come back for May, but the summer season could recover. IAG shares rallied Wednesday alongside the rest of the market, priced on exactly that assumption. But if peace talks stall, Iran's foreign ministry spokesperson had already called the Axios report exaggerated before Wednesday's close, the refinery disruption persists, the fuel cost remains elevated, and the surcharges do not cover the full gap. The condition for the aviation recovery is not simply a ceasefire announcement. It is a ceasefire durable enough to allow Gulf refinery exports to resume at scale. Those are two different thresholds.
Post 9/11 offers a partial historical frame, though the mechanism differs. In 2001, the aviation demand collapse was immediate. Passenger traffic fell before fuel costs moved. In 2026, the sequence is inverted. Fuel supply is the constraint first, demand is holding, and the result is fewer seats available at higher prices, rather than empty aircraft. That inversion matters for investors tracking IAG and the broader leisure travel sector. The earnings pressure is on margins, not on load factor. The W.H. Smith successor, now trading as T.G. Jones, announced it would close up to 150 stores on Wednesday, a data point that on its own sits far from aviation. But the proximity is not coincidental. UK consumer spending is under pressure from fuel costs, mortgage resets, and higher food prices simultaneously, according to the latest nationwide data. The travel sector's summer season depends on discretionary spending holding up under that combined load. Next, the clothing retailer flagged on Wednesday it would raise prices by up to 8% outside Europe because of Iran war cost pass-throughs. Consumers are absorbing multiple inflation vectors at once. For IAG specifically, the verification point is the June jet fuel forward curve. If the Brent crude drop below $100 begins to pull jet fuel forwards down within the next 10 trading days, the market's Wednesday thesis, buy airlines on peace deal momentum, carries real weight. If jet fuel remains decoupled from crude and the forward curve stays elevated, the surcharge model becomes the floor, not the ceiling, and the earnings picture for the second half of 2026 gets harder. The FTSE 100's 2.2% single-day move was priced on the headline. The actual trade is in the spread between crude and jet fuel, a number most equity investors do not watch in real time, but that every airline treasurer does. The question is whether the two converge fast enough to validate what the index already assumed. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.